Hi there, welcome to Kneppyinvests. The CBA, or Commonwealth Bank of Australia, is the largest company on the ASX by market cap. I can confirm that by our market index. Yes, CBA has a market cap of 220 billion compared to BHP, which has a market cap of 211.8 billion. But you also notice that CBA share price has increased 25% in the past year, whilst BHP share price has dropped 6%. So usually BHP, which is, by the way, the largest mining company in the world, is Australia's largest company. Well, not Australia's largest company, it's the ASX's largest company. That's usually how it plays out. But right now, CBA is the biggest company on the ASX. And when it comes to the biggest companies on the ASX, I always wonder, is or could this company be a buy? So I have been asking myself that question over the past few weeks. Now, I do have a bit of a history with this company. So, a bit of a soft spot, call it what you will, with the Commonwealth Bank of Australia. My very first savings account was with the CBA. My very first job out of university was with the CBA. I held that position for 9 months before I left because it was a pretty crappy place to work. My first trading platform or investing platform was ComSec, and I still use ComSec because I really like that platform. And probably most importantly, the very first shares I bought on the ASX were CBA shares. And the reason I bought CBA shares is because I knew CBA. And I knew this was one of the best companies on the ASX. Well, at the time, I thought this was one of the best companies on the ASX. So it was a no-brainer. So when it comes to whether or not a company is a buy, it's all about personal preferences and our personal investing strategies. Hopefully, we all have unique, different strategies. And that's the one in the most important thing. We should develop our own investing strategy that fits ourselves, fits our personalities, fits our risk profile, that sort of thing. So whether or not I consider Commonwealth Bank of Australia to be a buy is based off my own preferences, my own investing strategy. You could come up with your complete different answer. So remember that as I go through this video. What I want to do in this video is I'm going to go through the process I use to discover or find out whether a company, CBA in this case, is a buy or not. So how do I come to this decision? What are the things I look for? The first thing I look for is the quality of the company. Now, on the quality spectrum, you can go from the highest quality company in the world, which could be NVIDIA, could be Microsoft, who knows. Then you go all the way to the lowest quality company in the world, which could be a company that existed for 5 minutes. Where's CBA fit in that spectrum? I am biased. I think I know the answer to that, but I do want to delve a little bit deeper to make sure my bias is well founded. And then when I've realized where the CBA might fit in the quality spectrum, I look at valuation. Now, when it comes to valuation, it's all about whether a company is cheap or expensive. Now, the question on whether a company is cheap or expensive is not based off the share price, which might be a surprise to some people, because I do know some people who just look at the share price of a company and determine whether the company is cheap or expensive based on the share price. Yes, for example, they would look at CSL, $311 compared to Telstra, $3.88, and go, well, Telstra's cheaper because the share price is lower. That's not the way it works. And so I'll delve into whether or not I believe CBA is cheap or expensive. And that's a pretty big decision when it comes to whether this company could be bought, not particularly, even if I think this company is low quality or high quality, valuation always matters, even if you're a technical analysis person or a chartist. So always look at valuation, no matter whether I think the company is high or low quality. And the last thing I look at is the chart, technical analysis. Now, sometimes if I was just looking at the chart, ignoring valuation, ignoring quality, I could come to a complete different answer. But I am incorporating valuation and quality when it comes to technical analysis, because I believe using all three can really help my returns moving forward. So I'm going to go through all these three different factors in determining whether CBA is a buy. So let's start off with quality. What I'm going to do is I'm going to use FinChat and Guru Focus. And the things I look for in determining the quality of a company involve growth, so revenue, earnings, and dividend growth, particularly per share growth. Sometimes it's harder to find revenue per share growth. So in FinChat, you don't have it, but in Guru Focus, they do provide revenue per share growth, which I'm very thankful for Guru Focus for providing that. So I am looking for growth. I want companies to have growth. In fact, I consider high quality companies to have growth. They need growth for me to consider any company to be high quality company. Other things I look at include margins, gross margins, net margins, operating margins, particularly gross margins, and also return on equity, return on invested capital, return on capital employed, return on assets. So let's start off with the company's CBA's growth over the past 10 years, 5 years, 3 years, or 1 year. I tend to focus on 10 years and 5 years. I want to look at the longer term. So let's have a look at the last 10 years. How has Commonwealth Bank of Australia grown their revenue, earnings, and dividends during that period? Now, you do get slightly different answers depending on which platform you look at. For instance, the Commonwealth Bank of Australia says the 10-year revenue per share growth has been 0.4%. Earnings has grown at 0.2%, and dividends, in fact, negative 0.7%, which surprises me. Very little growth in CBA. Now, the other thing you'll notice here, price or total return has been 10.10% per year, which sounds pretty good. That's actually a pretty nice return over a 10-year period. But keep in mind that total return includes share price or capital growth, and the share price of Commonwealth Bank of Australia has significantly grown in the past year. In fact, the total return of this company in the past year is 31.1%. So that probably does lead into the valuation of this company. So I'm getting a little bit ahead of myself right now. So let's just go to FinChat and just see if their growth numbers are a little bit different. So revenue growth is actually not available for some reason, but earnings per share growth over the past 10 years, 1.6%, and dividend per share growth over the past 10 years, 1.7%. So still really low, a little bit higher than Guru Focus, but still really mediocre growth over the past 10 years. In fact, this did surprise me. I expected a little bit more growth for CBA. The other thing to pay attention to here is dividend yield. Even this is quite mediocre, 3.46%. You could put your money in a Commonwealth Bank savings account and get more than 3.46%. So that actually did surprise me as well, how the dividend yield is so low. So right now, based off the growth of this company, I could not give this company a high quality status. Now, on the flip side, return on equity is at 13.5%. This is a 5-year average via FinChat. Return on invested capital is 0.92%. So if you go to the Commonwealth Bank of Australia, they don't have the numbers here, which is a little bit disappointing, but they have the last 5 years. If you look at return on equity via Guru Focus, it actually doesn't change much from year to year. It's between 13.6% and about 13.4%. Return on assets fairly low, but that's another debate there. But return on equity is actually quite good for this company, and I typically look for return equities above 10%. So if you just look at return on equity to determine whether a company could be high quality or not, you actually might get a tick here for CBA. But I do think growth, just my opinion, growth matters. Growth is important. So based off the lack of growth in this company over the past 10 years, I probably would not say that Commonwealth Bank is a high quality company. The other question is, what about future growth? Now, based off what Matt Coman, the CEO of CBA, has mentioned, very limited growth moving forward. Lower risk, but limited growth. So I don't expect much growth in this company over the next 5 years or even 10 years. In fact, dividend per share growth, forward looking at the past next 2 years, 0.83% according to FinChat. They also have earnings per share growth estimated at 13.2%. So it's actually quite nice there. But that's estimated growth in the future. So In my opinion, just my opinion, CBA is not a high quality company. Okay, so let's have a look at valuation. And this is where it becomes really interesting for this company. In fact, the whole reason I'm doing this video is based off one of these valuation metrics. So again, it's not the share price. Share price means nothing, 131.63. It's about valuation metrics, P ratio, price to book. You could also look at EV to EBIT, EV to EBITDA, price to free cash flow, EV to free cash flow, all those sort of things. But I'm just going to focus on P ratio and price to book. Now, for banks, I prefer to use price to book. It's, I think, a better valuation metric for these type of companies. But let's start off with the P ratio. In fact, I am using the price to book here. So let's just go to price to, for some reason, they like yellow. FinChat likes yellow. So what I'm going to do is, there we go. It's now in blue. I actually like blue. I'm a blue man. So this is the P ratio history for CBA going back 10 years. This is how you should use valuation. Don't look at the share price or anything. Look at the P ratio history, the price to book ratio. So the P ratio of CBA right now is 22.9, which is a 23. 23, which straight away says to me this company is overvalued. That's all I need to know. This company is overvalued because I know 23 for CBA, 23 for a bank is really high, historically high. If you go back through the last 10 years, very rarely has the P ratio of this company been above 23. The only time it was above 23 was in 2021, when the earnings of this company were suppressed because of COVID-19. So I'm going to ignore that period because of COVID-19. So if you go back through the last 10 years, very rarely has a P ratio of this company been above 20, let alone 23. In fact, from 2014 through to the COVID-19 period, the P ratio of CBA fluctuated between 13 and 18. Yes, 13 and 18. Now it's 23. So just based off the P ratio of this company, it's expensive, not cheap. Okay, so do we get the same thing when we look at price to book? My preferred, whoops, got to pick the right one. My preferred valuation metric for banks. Okay, here we go. The price to book of CBA is above 3. In fact, that triggered me to do this video. And the reason it triggered me is because I know the price to book of banks very rarely get above 3. In fact, over the past 10 years, only once before today has the PB of Commonwealth Bank of Australia been above 10 or been above 3, and that was back in 2015. March 2015, the price to book of CBA was 3.1. Typically, the price to book of this company ranges between, we'll say about 1.75 and 2.5. Now, what's funny, very rarely has the PB of this bank been below 1.5. Typically, I would look at a bank and think anything below 1.5 is fair value. Anything below 1 would be getting into the good value range. Anything above 2, overvalued. So historically, CBA is in the overvalued range when it comes to price to book. It typically is above 2. So that is telling us that the market always pays a premium for this company. So again, it's above 3 right now. And this is where it becomes really crazy. Not crazy, but this is when you are taking on a risk buying CBA right now with a price to book of 3. The reason I'm saying there is a risk is because the expected returns of this company moving forward are really low right now. And the reason I'm saying it's really low right now is because and you can just see this, how the price to book has really risen hard. It's gone from 2.25 to 3 in the past 6 months. That's what's called multiple expansion. So there's been no financial expansion. Profits haven't grown. It's just the market is more willing to pay a premium for this company over the past 6 months. Can we expect that to continue? I would doubt it. Now, it's not out of the question, but I would doubt that the market would look at CBA right now and go, yes, I'm willing to pay a price to book of above 3. Could we see the price to book get to 4? It would be historic to see the price to book of CBA get to 4. It would be historic. It would be in the news. Would we see P ratio of CBA get to 25 or even 30? Again, it would be historic. It would be in the news. So watch, if you're buying CBA shares right now, what you're saying is either the company would have to significantly grow their profits over the next few years to justify the current valuation, or the market will continue to pay at the current premium it is right now. That's the only way the share price of this company will remain at these levels. So there is a risk, and the potential rewards are limited. I don't see much model expansion moving forward. So without model expansion, you need financial expansion to drive the share price higher from here. Even if you get financial expansion, you might see multiple contraction and the share price might not do anything. So there is risks moving forward for CBA if you bought shares at current prices. Just my opinion. Now, here's something interesting. This is where it gets really interesting. If we go back to March 2015, let's go all the way back to March 2015. How long did you have to wait before the share price got back up to those levels? So this is actually a beautiful looking chart of CBA all the way to when the price to book got to above 3. A beautiful looking chart from 2012 to March 2015. Share price went from $50 to $96. And when the price to book of CBA got to above 3 in March 2015, share price rallied to a high of $96. So just imagine you bought some shares at that particular point in time. I did a video back then. Share price was $96, and I did a video saying, it's ridiculous. The PB of Commonwealth Bank of Australia is 3. Although, to be honest with you, I probably didn't even think about the price to book of banks back then. So $96, the chart looks pretty good as well. If you were just using technical analysis, you'd say, oh, it's a buy. Chart looks brilliant. Okay, so you bought some shares at $96 in March 2015. So you got some dividends after that. But let's have a look to see when the next time the price got to $96 for CBA. So remember, March 2015. Let's have a look. So we're in 2012. Oh, got close in 2020. We got up to $91 in February 2020, just prior to COVID-19 financial panic. I just have to do auto fit here. So we're just looking at when the share price gets to 96, and there we have it. Share price got above $96 in May 2021. 6 months or over 6 years after you bought shares in March 2015. You had to wait 6 years before the share price got back up to those levels you bought. Sure, you received some dividends, but more than likely the dividends weren't that much. And that is the risk moving forward right now for the CBA. You might have to wait, we might have to wait another 6 years or maybe even longer for the share price to get back up to these levels. But here's the kicker. If I was just using technical analysis, this is the chart. Chart doesn't look that bad, does it? It's a pretty nice uptrend. Share price could continue. And if I just ignored valuation and the quality, and I was just using technical analysis, I probably would say the momentum is behind CBA right now. And to be honest with you, if I own shares in this company right now, I probably would not sell because of the chart right here. Wouldn't buy, but I definitely wouldn't sell because you have momentum on your side. And there's no reason why the market could not remain irrational for a longer period. It could remain irrational for the next 6 months. Just don't know. So I probably wouldn't sell right now if I own shares. But definitely, because I'm not a shareholder right now, I definitely would not buy shares in CBA just because of the valuation, just because I don't think this company is a high quality company. In fact, even if I thought this company was a high quality company, just because of valuation, that would be keeping me from buying shares in this company just now. Okay, so that is or are the processes I go through in determining whether a company is a buy. And for me right now, CBA is not a buy, probably not a sell either. So probably a hold. I'd say a hold if I own shares in this company, but I don't. So it's irrelevant. That's why I go through this process. I don't own shares, but I just want to know, is CBA a buy right now? Okay. I'd love to hear from you if you are a CBA shareholder. What are you doing? Are you just maintaining your shares in this company? Are you a long-term shareholder? And that's the other thing. If I bought shares in this company 30 or 40 years ago, probably wouldn't even be thinking about selling shares in this company because share price has run up a lot. You get nice dividends based off your initial capital. So It all depends on your own personal circumstances. If you're a long-term shareholder of this company, no way I'd sell. Also, you have to think of the tax reasons, that sort of thing. But if I was not a CBA shareholder right now, if I was new to the market, a new investor, would I be thinking about buying shares right now? The answer to that is probably not at this point in time. So leave your thoughts, your questions in the comment section of this video. Otherwise, I'm not a financial advisor again, but if you do need financial advice, make sure you seek out someone who's qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.